Good morning everyone, my name is Mark Quinn. I'm a chartered financial planner and tax advisor based in Portugal, and I help UK nationals relocate to and plan for their lives in Portugal. In this video I want to cover some key changes as a result of the UK budget on the 30th of October and how it impacts those of you that are looking to move to Portugal or are living here already. Now, the first fundamental change that was introduced in the budget was the basis for assessing inheritance tax. Now, for around 200 years, if you originate from the UK, so in very simplistic terms, if you originate from the UK, you have what's called a UK domicile of origin. And it's domicile that's been used to assess inheritance tax. So even if you left the UK many, many years ago and never returned there, by virtue of the fact that you have a UK domicile of origin, you were always brought into the scope of UK inheritance tax, and that would apply on your worldwide estate. So 40% inheritance tax on your worldwide estate, even if you never return to the UK. Now, it was possible to acquire a new domicile of origin, and you did that by A, moving country and establishing a new home there, but B, and this was the more complicated area because it involved shedding your ties and connections with the UK. So it was quite onerous. It could, for example, include closing bank accounts, selling UK assets, giving up UK driving licenses, membership to clubs and societies, limiting the time that you spend back there, learning a new language in the country that you're now living, and in the most extreme example, it could involve giving up your British passport. And these were all steps that you could have taken to evidence the fact that you no longer see the UK as home. So you're making the argument to HMRC that your new country of residence, in my case Portugal, is now home and you've lost your UK domicile of origin effectively. Now, this was a very grey area. There was no sort of one conclusive test that you could establish to know what your domicile is, and therefore there was no certainty that you had when you were planning for inheritance tax and estate planning. The new rules mark a major shift in how HMRC will now determine your liability to inheritance tax. So what the Chancellor announced in the budget last month was, with effect from April 2025, so April next year, IHT will no longer be based on your domicile, and it's now going to be based purely on residency. And how it will be determined is if you've been a non-resident, so if you've been outside of the UK in at least 10 out of the last 20 years, then you'll have effectively no IHT liability going forward, which is an incredible planning opportunity for those of you that are looking to relocate to Portugal permanently. The only exception to the new rules is that any assets left in the UK will always be in the scope of the IHT tax charge. So HMRC will always be able to attack UK-based assets. So that includes obviously UK-based property, UK-based pension schemes, investments, bank accounts, etc. So the obvious planning opportunity here is to try and remove as many assets as you can from the UK if inheritance tax planning is important to you. So the new rules actually introduce two new concepts, and that's the concept of long-term resident and non-long-term resident. And non-long-term resident simply means you've been out of the UK more than 10 years out of the previous 20. If you haven't, and you're therefore still a long-term resident of the UK, then the status quo effectively applies. Your worldwide estate is subject to tax at 40%, although you do have your exemptions and reliefs. The main one is that you have £325,000 each to offset against your taxable estate, and you also may have a main residence nil rate band, although that is tapered away above £2 million and gradually disappears as your estate increases over that level. The budget also introduced some planning opportunities for those of you that are returning to the UK after you've been out of the UK for 10 years. So if you've been a non-long-term resident, i.e. you've been clear of the UK tax net for 10 complete tax years, you can return to the UK and take advantage of a new regime called the Foreign Income and Gains regime, and that means that for a period of 4 years after returning to the UK, you can take foreign income and gains free of tax. In addition to that opportunity, when you return to the UK, again assuming that you've been clear of the UK for 10 complete tax years, when you return you don't actually have an IHT liability again until you've been a UK resident again for 10 years. So 2 new opportunities, the 4-year foreign income and gains system, and also no IHT liability for 10 years after returning to the UK. Some of you will also be aware of the 7-year rule when it applies to inheritance tax. So a 7-year rule applies to potentially exempt transfers or pets. And a pet is simply a gift from one individual to another individual. In simplistic terms, there can be pets made on gifts to certain trusts, but as a general rule, it applies when one individual makes a gift to another. Now, the 7-year rule means that after you make that gift, you then have to live another 7 years in order for that gift to be completely outside your estate for inheritance tax purposes. If you die within the 7-year period, all or part of the gift gets added back to your estate at the date of death and taxed accordingly. Now, the new rules introduce the concept that if you have been a non-long-term resident, so you've been outside of the UK for more than 10 years, you can make a pet, so a gift to a family member, friend, etc., and it will be outside your estate immediately if that gift was of a non-UK asset. So there's no longer that 7-year period that you have to wait if you're gifting as a non-long-term resident and you're gifting non-UK assets. A key change of the UK budget on the 30th of October was a fundamental shift in the treatment of UK pensions. Now, as the rule stands at the moment, UK pensions, or all recognised pensions for that matter, so overseas pension schemes such as qualifying recognised overseas pension schemes, QROPs, or qualifying non-UK pension schemes, QNUPs, they're also outside the scope of a UK inheritance tax charge if planned correctly. Now, this is going to change. So in the budget, the Chancellor announced that with effect from April 2027, UK pensions and all pensions are going to be brought in the scope of inheritance tax charge. Now, this is a fundamental shift and has an impact on the planning we will be doing for clients going forward. Because up until this point, and indeed up until April 27, our general advice is that people should retain as much money in pension schemes as possible and fund their lifestyle, so take income and withdrawals from elsewhere in their assets. So if you had, for example, ISAs, cash in the bank, investment portfolios, general investment accounts, the general planning point was to eat into those funds first before touching the pension scheme. And that was simply because pension schemes are always outside the IHT tax charge. Now, if the pension scheme is now going to be brought within the scope of inheritance tax, it loses one of the key features of pension planning. In addition, this impacts in relation to the change to inheritance tax and how that's going to be determined from April next year, because those of you that will be considered non-long-term residents, so you've been clear of the UK tax net, you've been outside of the UK for 10 years or more, you won't have an inheritance tax charge anymore. You won't have that liability to UK inheritance tax, with the exception of UK-based assets. Now, a UK pension scheme will still be treated as a UK-based asset and therefore be subject to the 40% tax charge. So the obvious planning angle there is to remove the UK pension scheme from the UK system. And you can do that in one of several ways. You could transfer to a QROP, so a qualifying recognised overseas pension scheme, However, again in the budget, they introduced a 25% tax charge to transfers to QROPs. So this has become a lot less attractive. The other planning angle would be to withdraw the pension scheme in full at your marginal tax rates. Now this is going to be quite expensive for you if you don't qualify for the non-habitual residence scheme, which gives you 10 years of tax efficient living here. But if you do qualify for non-habitual residence and you either have the 0% or 10% tax rate, and then you could draw down fully the pension scheme, remove it from the UK tax net, pay the 10% tax rate or hopefully 0%, and that will be the extent of your liability, because under the tax treaty the UK won't have a taxing right on any income paid from a UK based pension scheme. So you've cleared it from the UK tax net, you've saved your estate 40% tax, and at the same time you've taken advantage of that 10-year window that you can use to extract money tax efficiently from pension schemes. There is also a potential double tax charge with pension schemes and death benefits, because if UK pension schemes are now going to be brought into the scope of IHT's tax charge at 40%, there may also be income tax charged on the beneficiaries at their marginal rate when they receive the proceeds if you die after age 75. So in worst case scenario, your beneficiaries have a 40% inheritance tax charge, and they then pay an income tax charge up to 45%. So it can be quite painful. So we're encouraging people to look at their affairs as a whole now, reassess if what they're doing is still tax efficient and effective in light of the budget changes introduced on the 30th of October. Now, as I stress in all my videos, none of this is advice, it's just information only, but just gives you some pointers and a few planning ideas that you really need to talk through in detail with your advisor, your financial advisor and tax advisor. And if you wanted to reach out to me to look at your affairs and do a free assessment and review of your situation, and if anything can be improved, it will be a pleasure to do so. Thank you.